Did I?
No, you saved it twice and submitted the second save.
Okay, so guys, we are going to talk about responsibility accounting today. We're going to skip 12 next week, and then the next week I believe we do 13 and 16 or 14 and 16. So decentralization in companies have many benefits. Lower level decisions, generally speaking, are based on those people that know about what's the best scenario. Lower level managers gain experience in decision making. Lower level managers can respond quickly to customers, and ultimately everyone is happier when they get to make the decisions. Disadvantages of lower levels, or what we call decentralization, with lower level making those decisions. They might not see, those individuals might not get to see the big picture of a company. Maybe they don't have the coordination necessary that those at a higher level can give. But managers, what we're talking about today in responsibility accounting, managers ultimately make the decisions and are held accountable for those decisions. Because the beauty of this is they possibly can even control these decision-making scenarios. A responsibility center is used for any part of an organization whose manager has control over and is accountable for cost, profit, and investment. So a cost center, we know that area that a manager has control over costs, but not necessarily control over revenues. A profit center is that division where a manager has control over both the costs and the revenues. So where a manager has control over the sales, the interest, other aspects of revenue, and the various manufacturing costs, commissions, and labor. A segment is where a manager has control over the whole shebang, even investments and operating assets. So here we're going to look at some various ratios, specifically return on investment, and we're going to see that if we change sales or costs or assets, that also will play out a change in our ratio. So the return on investment is going to be calculated by our net operating income, which is income before interest and taxes, dividing that by our average operating assets. So operating assets, we're going to look at cash, accounts receivable, inventory, plant and equipment, and other productive assets. So this rate of return on investment, net income before interest and taxes divided by our average operating assets. Most companies use the net book value of depreciable assets to calculate average operating assets. So here, what we just talked about, return on investment, our margin is going to be calculated by our net operating income divided by our sales. Turnover would be our sales divided by our average operating assets. So ultimately, we can look at return on investment being margin times turnover. Do you see how both in this, the margin, the net operating income divided by our average operating assets, if we get rid of the sales, you've got your return on investment scenario there. So, Regal Company reports the following. We have our net income of $30,000. We've got our average operating assets of $200,000. We've got our sales of $500,000 and our operating expenses of $470,000. So we could figure this out by our net operating income divided by our average operating assets, our 30,000 divided by 200,000. Or we can go the net operating income divided by sales times our sales divided by our average operating assets. Okay? So here we've got the 30,000 divided by 200,000, or in this case, they're using both the scenarios here, 6% times 2.5. In this case, our return on investment is 15%. So our net operating income is 15% of our average operating assets. Make sense? Now let's assume that Regal's manager invests in a $30,000 piece of equipment that increases sales by $35,000, while increasing operating expenses by $15,000. So basically, our Regal company, let's just see here. They want to invest in a $30,000 piece of equipment, which will increase the sales 35, expenses 15. So ultimately, 20,000, it would increase the net operating income, right? So now our net operating income has gone from 30 up to 50, and our average operating assets have gone, they were at 200, now they're at 230, because of course we added 30,000. So our new return on investment, by adding that one asset and the change of our income, would show our return on investment went from 15%, now it's at almost 22%, 21.8%. Return on investment disadvantages: in the absence of the balanced scorecard, management may not know how to increase return on investment. Managers often inherit committed costs over which they can't control. Managers evaluated on return on investment may reject profitable investment opportunities. Now we're going to look at this residual income and see the benefits and the weaknesses of residual income. Residual income is net operating income above some minimum return on operating assets. This is a little different from return on investment, because return on investment measures net operating income earned relative to the investment in average operating assets. Here, with residual income, this is going to measure net operating income earned less the minimum required return on average operating assets. So we've got Zephyr Inc., and the retail division of Zephyr has average operating assets of $100,000 and is required to earn a return of 20% on these assets. In the current period, the division's earning $30,000. So are they earning at least 20% on those assets? Yes, they are. Let's calculate residual income. So if we see that our operating assets are at 100 and we're required to have 20%, that means the minimum requirement is $20,000. We're actually making 30, so our residual income, that above and beyond that minimum requirement, is the residual here is $10,000. Residual income encourages managers to make profitable investments that could be rejected by managers if they're using just return on investment. So guys, what do you think about this? Redmond Awnings, a division of Wrap-Up Corporation, has a net operating income of $60,000 and average operating assets of $300,000. The required rate of return for the company is 15%. What is the division's return on investment? So Redmond, a division of Wrap-Up, has a net operating of 60 and average operating assets of $300,000. The required rate of return for the company is 15%. The return on investment, wouldn't it be 60,000 divided by 300,000 or 20? So if the required rate of return is 15%, then we're definitely got residual income happening, don't we? Redmond Awnings, operating income of 60, average operating assets of 300,000. The manager of the division is evaluated based on return on investment. Will she want to make an investment of 100,000 that would generate additional net operating income of 18,000 per year? So guys, think about it. She is right here making 20%. If she chooses to make an investment of 100 and this net operating income would increase 18,000 a year, wouldn't that lower her rate of return on investment? So instead of it being at 20%, do you see how it would go down? That would harm her if she's being based on return on investment. It would decrease. The company's required rate of return is 15%. But in this case, would the company want the manager at the Redmond Awnings division to make an investment of 100,000 that would generate additional net operating income of 18,000? If that's the standard, then she would want that, because the minimum rate of return is 15%. This would give her 18%. So do you guys understand, depending on which avenue they're being rated on, depends on what kind of decisions they're going to make. Here, Redmond Awnings, a division of Wrap-Up, has a net operating income of 60, average operating assets of 300. The required rate of return of the company is 15%. What is the division's residual income? What amount would be above and beyond that 15%? Perfect. So the 60,000 operating income minus the required rate of return of 45 gives that residual income of 15. Okay? If the manager of the Redmond Awnings division is evaluated based on residual income, will she want to make an investment of 100,000 that would generate additional net operating income of 18? Yes, she would want to, because that's going to be above and beyond that residual income. Next, determine the range within which a negotiated transfer price would fall. So basically what a transfer price is instead of having someone outside of a company provide a good or service, this is when one segment of a company provides goods or services to another segment of the company at a specific charge. The fundamental objective in setting transfer prices is to motivate managers to act what's best for the company as a whole, not what's just best for their division. So primary approaches to setting these transfer prices, you can negotiate them, or you can set them at cost using variable or absorption costing, or you can use market prices. So there's a lot of different ways in which you can set these transfer prices. A negotiated transfer price results from discussions between the selling division and the buying division. So, which basically would be the best scenario to make everyone happy. There's going to be an upper limit and a lower limit to decide if it's sustainable, workable in this particular division. So here we've got a grocery store, a warehouse. Assume the information that's shown is related to the West Coast plantations and the grocery mart. Both are owned by the same company. Now, West Coast plantations can harvest 10,000 crates of oranges a month. It's got a variable cost per crate of $10 per crate. And it's got fixed cost of $100,000 a month. And it can sell these navel oranges for $25 a crate. At the grocery store, they purchase the navel oranges at $20 per crate, and they sell about 1,000 crates a month. So, do they want to purchase their oranges from within the company? The selling division's lowest acceptable transfer price is calculated by the transfer price has got to be greater than or equal to the variable cost per unit, which was $10, plus the total contribution margin on lost sales divided by the number of units transferred. So, to calculate the lowest price and the highest price, the buying division's highest acceptable transfer price is going to be related to whatever cost they're going to pay for these oranges has to be less than the cost of buying it from outside suppliers. Okay? Now, in this case, if there's an outside supplier, then you can go that route. If there isn't an outside supplier, then it's going to be a little different scenario. So if West Coast has idle capacity to help the grocery store, because the grocery store needs 1,000 crates, in this case, the transfer price, the selling division's lowest possible transfer price is going to be the difference of $10 plus the cost minus 1,000 crates to be at $10. So basically, the $10 is the variable cost per crate. But the person who's buying the grocery store who's buying these oranges, the most they're going to want to pay is $20 because they can buy it elsewhere for $20. So to make this transfer price work, it's got to be in the range of $10 to $20 for both parties to be satisfied. If West Coast Plantations has no idle capacity, then in order to give the grocery store some oranges, they would have to sacrifice other customer orders. If that's the case, then for West Coast to want to sell them to the to the grocery store, they would need to sell them to the grocery store for $25. And then in this case, for the grocery store, the most they're willing to pay is $20. So if this is the case with no idle capacity, it won't work. It's a no-go. Does that make sense? It would not work. But if West Coast does have idle capacity, let's say instead of 1,000 crates, they have 500 crates of idle capacity. And in that case, if it has to sacrifice some other customer orders, then the way in which the selling division would determine if they can do it is they would take the variable cost and they would take the sales price minus their expenses at 500 crates, divide that by 1,000 crates to come up with $17.50 being the lowest possible cost they could utilize to sell those to the grocery store. If this is the case with 500 crates of idle capacity, then there would be an acceptable transfer price between the $17.50 and the $20. Okay? If a transfer within a company would result in higher overall profits for the company, there's always a range of transfer prices within which both the selling and buying divisions would have higher profits if they agree to transfer. If managers are pitted against each other rather than against their past performance or reasonable benchmarks, a non-cooperative atmosphere is going to happen and isn't a good sign. So generally, there's got to be a better way to negotiate transfer prices. Many companies set transfer prices at either the variable cost or absorption cost that gets incurred by the selling division. Drawbacks can include using a full cost as a transfer price, or the selling division may never show profits. Cost-based transfer prices don't necessarily bring incentives too. If you do transfer prices at the market price, that's probably the best scenario for everyone. The market approach works best when the product or service is sold in its present form to outside customers and the selling division doesn't have idle capacity. But if the selling division has idle capacity, it's probably not a good approach. Let's look at a problem real quick. Okay? Okay. There. Okay, so we've got beginning balances on the balance sheet, ending balances, the income statement. The company paid dividends of $15,000 last year. The investment of this Busan SA on the balance sheet represents an investment in the stock of another company. The company's minimum rate of return is 15%. Now, our job here, compute the company's average operating assets for last year. So, operating assets, we're going to take the cash, the accounts receivable, the inventory, and the plant and equipment. Okay, we're not taking the undeveloped land or the investment in Busan. So if we take these 4 different categories, take the beginning balances, the ending balances, and then average them out. Do you see here that we average them at $1,620,000? It's going to be your average operating assets. You see how to figure that? Next, it says compute the company's margin, the company's turnover, and the return on investment for last year. So the margin is the net operating income divided by sales. So here, net operating income, $405,000 here. The sales are $4,050,000. 405 divided by the $4,050,000 gives us a margin of 10%. The turnover is going to be our sales, the $4,050,000 here, divided by our average operating assets here of $1,620,000 of 2.5. The return on investment is the margin times the turnover, right? The 10 times the 2.5 gives us 25%. Got it? Now, it asks us, what is the residual income? Well, we need to know the minimum required rate of return. It's 15%, isn't it? So the required rate of return, or the minimum required rate of return, is 15%, which would be the average operating assets times 15% is $243,000. If the operating income's at 405, wouldn't it be the difference, which is the residual income? Make sense? Questions? Got it? I'm sorry, what?
It says 10% is wrong for the margin. I'm not really checking.
$405,000. You see 405 divided by the 4,050,000.
Oh, it's because I put a percent symbol in.
Yep, I get you. Okay. Okay, let's go back here. Now, charge operating departments for services provided by service departments. So, oftentimes, operating departments have to do work for the company as a whole, carry out central purposes of the company, and oftentimes service departments while they're essential for the operation of the company, they might not really directly be involved in operating activities. Service department costs are charged to operating departments for a lot of reasons. Encourage operating departments to use service departments' resources smart, to help measure the profitability of operating departments, getting a more extensive understanding of cost data, and then for incentive purposes. So, if we charge various departments by behavior, variable and fixed service department costs should be charged to operate departments separately. Now, variable service department costs should be charged to consuming departments according to whatever the cost driver is that makes the cost occur. Charging fixed service department costs to consuming departments in predetermined lump sum amounts. If this is the way we do it, charging fixed service department costs to consuming departments based on the consuming department's peak period or long run average servicing needs. So there's got to be a way in which we compute these. Budgeted variable and service department costs should be charged to operating departments. So, how do we do it? If we look at SIPCO, they've got a maintenance department and 2 operating departments, cutting and assembly. Variable maintenance are budgeted at 60 cents per machine hour. Fixed maintenance costs are budgeted at $200,000 per year. Data regarding this year shows for operating departments, for percent of peak period in cutting, the capacity that's required is 60%. The hours planned are 75,000 hours, but we used 80,000 hours. For assembly, the capacity is at 40%. We planned 50,000 hours, but we used 40,000 hours. So, we planned for 125,000 hours, but we actually used 120,000 hours. So how do we go about allocating maintenance cost to the 2 departments? You can take the 80,000 hours, the hours actually used at 60 cents, and allocate that amount to the cutting department. The hours actually used in assembly were 40,000. So we can use this allocation of the fixed cost, the 200,000 of fixed cost, and as a result of this, percent of peak period capacity. We take our variable cost based on the actual hours at 60 cents, and then allocate the fixed cost based on peak period capacity to allocate between the 2 departments. Foster has an ambulance service that's used by the 2 public hospitals in the city. Variable ambulance costs are budgeted at $4.20 per mile. Fixed ambulance costs are budgeted at $120,000 per year. Data relating to the current year show Mercy Hospital and Northside Hospital. So peak period capacity, Mercy requires 45%, Northside 55%. They planned these miles, but they actually used 16 and 17.5. Okay? How much ambulance service cost will be allocated to Mercy Hospital at the end of the year? So if we allocate the fixed costs by their peak period capacity, the 120,000 at 45% is what, guys? 45% of 120,000. 54,000?
I just read out the first answer. I just saw one.
And then 420 times 16,000 is what?
That is 67,200.
So if you take the 67.2 plus that 54,000, Mercy will be allocated 121.2. Make sense? North side will be at 139.5. Pitfalls in allocating fixed cost. If you use a variable allocation base, it's going to fluctuate from one year to the next. And what happens in your department isn't the only thing you have to worry about. You also have to worry about what's happening in other departments as to what's going to get allocated to your department. Also, using sales dollars as an allocation base can be negative, and sales of one department can influence the service department costs that are allocated to the other department. So we've got this Autos or Us company. It has a service department and 3 sales departments. We've got new cars, used cars, and car parts. The service department costs total $80,000 for both years in the example. Contrary to good practice, Auto or Us allocates the service department cost based on sales. So you see here, the new department had sales of $1.5 million. The used department had sales of $900,000, and the parts had sales of $600,000. So 1.5 to the whole $3 million is 50% of all sales were generated from the new department. Used was 30%. Parts is 20%. So if we allocate this based on sales prices, then the new car department's going to have to take 50% of all the costs. In the next year, the manager of the car department increases sales by $500,000. Sales in the other departments are unchanged. Then, how do we go about allocating that $80,000 for the second year? So, because their sales increased and none of the others did increase, you see how they're getting hit with taking a bigger cost, a bigger hit of the allocation of the department cost. So, from the first year where they took $40,000, now because they worked harder, now they're having to take $45,000 because their sales increased. If you were the manager of the new cars department, would you probably complain about the increased service department costs allocated to your department? Yeah. It doesn't seem fair, does it? Because you worked harder and the other departments or the other sales units didn't increase their sales. You're getting hit with that. So let's go back and look at some problems here. Tasman Products has a maintenance department that services equipment in the company's farming department and assembly department. The cost of this servicing is charged to the operating departments based on machine hours. So we've got here what we budgeted and what is actual. So we budgeted at 40 cents per machine hour. Data for the forming department and the assembly department show our peak percentage capacity, and then budgeted versus the actual machine hours. So you see here the forming department actually worked 30,000 more hours, and the assembly department worked 10,000 hours less than what they budgeted. The amount of fixed cost in the maintenance department is determined by the peak period requirements. Okay? How much maintenance department costs should be charged to the forming department and to the assembly department? So you see here, if you take the 40 cents variable cost per machine hour, and actually in the forming department you had 190,000 machine hours, that variable cost here is 76,000. In the assembly department, the actual hours were 70,000 at 40 cents. So that's how you're going to apply the variable cost. Regarding peak capacity, I believe we know it's 150,000 were the fixed costs. We take the various peak capacities and we allocate them accordingly. So in this case, the forming department would have 181,000 charged to it, and the assembly department would have 73,000 charged to that department. Does it make sense how we're doing that, guys? Then, how much, if any, of the maintenance department's actual cost should be treated as a spending variance and not charged to forming and assembly? Any difference between what was budgeted and actual cost would not be charged to the other departments. The costs not charged are spending variances of the maintenance department and are the responsibility of that department's manager. Okay?